Hello and welcome to BQ Prime. India's economic recovery remained on track in the fourth quarter of FY23, with the economy performing better than was forecasted and services in the lead. GDP figures were published a while back today, and to share his early insights on these figures, we're joined by DK Joshi, Chief Economist at CRISIL. So thank you so much for taking time out.
Thank you for having me.
So to begin with, I'd like to ask you about your first thoughts on the figures. I think we can both agree that the figures are definitely better than was expected.
Absolutely. I think at 7.2%, I think it's much higher than expected. And I think if I take you back 6 months, people were thinking of sub 7% growth. And I think to boot, this growth is over a higher base because the 21-22 numbers were revised up a couple of months back. So I think the momentum till 22-23 has been extremely strong.
Sure. And even when we glance at industry trends, so for instance, agriculture grew by 5.5% in Q4, manufacturing expanded 4.5%, and services, not entirely unexpected, continued to lead growth. So even separately, each of the components seems to have performed well, and each of them seems to have performed better than forecasted.
Yeah, absolutely. I think the services, as you rightly said, I think wasn't much of a surprise. I think the first estimates are not very accurate. So the second estimates, third estimates, I think they take into account more factors and they are able to get a more realistic picture of the economy. So the good news is that the numbers are getting revised on the upside rather than on the downside, because both are possibilities. And I think agriculture really did come as a surprise at 5.5%, which essentially means that the vagaries of weather haven't hit agriculture value added at all.
Right. So as you mentioned that, these are early figures and prone to revisions going forward, considering that these figures have surprised on the upside, I do want to understand if they should be taken with a pinch of salt at this point. How do we view these, just considering that quarterly figures especially are prone to revisions going forward?
Well, I think this estimate is pretty stable one. I think this is the third estimate of GDP for 22-23. And we have for the first time, I think the Q4 has been explicitly mentioned. I would say that this has a shelf life of almost till 2024, beginning of 2024, when we'll see the revisions in number. So this is a pretty stable number and I think has a longer shelf life than the first and the second advanced estimates that we saw earlier. So this is I don't think it's going to be revised anytime soon. I mean, not before early 2024.
Got it. Okay. And when we look at expenditure-wise trends, consumption was on a slightly weak footing the last time. What are you making out of it this time? Also, I'm not sure how to read into this, but despite growth on an annual basis, on a sequential basis, consumption did see a little bit of a dip in Q4. So how are you looking at these expenditure-wise trends?
Well, I think the annual trend is pretty strong. I think the 7.5% means it's growing faster than the GDP. And I think it's largely because of revival of services, which is leading to more income in urban areas. So urban consumption would be leading the consumption story here. I think the fourth quarter-on-quarter numbers are also influenced by the base effect. I think so. There were episodes of COVID, non-COVID. So I think that hasn't stabilized. So I won't read too much into the quarter-on-quarter numbers. I think they were very high in the beginning, and then they started coming down towards the end. So that was expected because of the base effect. I would be more sure of the annual numbers, I think, which I think should capture the picture much better.
Sure. Okay. What I also want to understand, so, considering that most of these figures are better than anticipated, how does one see these figures compared to pre-pandemic levels? How much of the loss have we been able to recover from what we can understand from these figures?
Well, I think if you want to look at the size of the economy in 1920, so we are about 10% higher today. Now, if there were no pandemic, we would have been much higher than that. I mean, so so there would still be a loss, what economists refer to as permanent loss, which essentially is the difference between the level of GDP in 22-23 without the pandemic and level of GDP with the pandemic, that is the current figure. So there is still a gap there, but that gap is getting narrower because the upward revision and stronger growth is narrowing the permanent loss figure.
All right. Okay. And what is the reason for the upside in the figures? Like, what is the contribution share? Do you think that industrial GVA was what led to the slightly higher than expected figure, considering services was pretty much in line with expectations?
Well, I think one of the, apart from the points that you mentioned, I think one is that the net trade, which is exports minus imports, that gap had shrunk. So it subtracts from the GDP. It subtracted less in the fourth quarter. So that is one. Second, I think the agriculture performance was extremely strong. I think that has helped the quarter four numbers. Actually, the biggest surprise is in the quarter four number. Quarter four was expected at 5.1. as per the second advanced estimates, but actually it came in at 6.1%. So essentially, I think the fourth quarter is what has surprised on the upside, despite I think we seeing some weakness in manufacturing, etc. But I think the services and agriculture, I think they have powered the economy in the fourth quarter, and I think that is what is reflecting in better numbers for the full year.
Got it. Okay. So how do today's figures change your estimates for FY24? The RBI, for instance, has retained its forecast of 6.5% for FY24. With these figures slightly higher than expected at this stage, how does that change the base? What is the expected impact on FY24 figures?
Well, it does change the base, but I think the situation is dynamic, and I think you have to take into account various factors. But what we are sure of is that the growth will be slower in FY24 than FY23, and our estimate is 6%. And there are two factors which will drag the growth somewhat downwards. One factor is the global environment, where we are seeing slower growth for 23, and the slower growth means slower growth of exports, because slow growth is coming from our major trading destinations like US and Europe. Upward revision of growth is in China, and we don't export much to China. So I think the export of merchandise goods will become a drag for us, and it will spill over to some of the manufacturing sectors like textiles, etc., where I think discretionary spending by the countries which are our trade partners, I think takes place. Now, second is the RBI has been raising interest rates, and we all know that interest rates impact the economy with a lag. And the RBI wants to control inflation via higher interest rates, and the route is via GDP. So they have to first slow the economy, then inflation comes under control. So we will see some moderating impact of higher interest rates also on the economy. So combination of these two factors will slow the economy from 7.2% to around 6% in FY24.
All right. So considering you mentioned that we will see the impact of higher interest rates in the ongoing fiscal year, and considering that consumption at this stage is still not as reassuring, do you think that consumption might be a little bit of a drag in FY24?
Well, I think there are two opposing factors playing out on consumption. One, I think, is that your inflation rate is edging lower. So I think lower inflation actually improves the purchasing power. But at the same time, interest rates has gone up. So that kind of reduces your ability to leverage and consume. So I think so. And as a net of these, I think we still believe that private consumption will remain a relatively stronger part, because the urban economy is doing extremely well. And because the services, about 2/3 of the services in India are in urban areas, and services are firing the economy. So urban consumption very strong. Rural consumption is also picking up, but I think it's tentatively picking up. A lot depends on what happens to the monsoons. I think although we have a normal monsoon forecast, but the weather vagaries can still play out. I think so. We need to watch the monsoon very closely. I think that is what is going to impact the rural part. The signals from the wages are positive. Wage growth in rural areas has picked up. The signal from Narega, I think, which the demand for Narega had reduced somewhat, which means that there are other opportunities there. So clearly, there's some movement, positive movement in the rural areas, but the bulk of consumption strength is still from the urban areas.
All right. So today we saw a couple of other data points being released as well. We saw fiscal deficit estimates come in, and that was a tad bit below the full year target for the government. On the other hand, we saw the index of 8 core industries data being published, and on a sequential basis, we actually saw a sharp contraction there. What are you making of these other figures? What's your takeaway?
Well, I think because GDP expanded at a faster rate than was expected, so fiscal deficit as a percentage of GDP will come down because the denominator has expanded faster. So that's not a surprise. I think the coming to the other issue of core industries, I think if you observe the core industry data, it's quite lumpy in nature, and I think it's very volatile also.
Yeah.
So I would not read too much into it, because I think if you see the investment momentum is still quite strong. So I would say that the core sectors overall will continue to do reasonably well, I think, even in 23-24, because I think investment momentum is expected to stay strong. I mean, and public sector is doing it. Private sector investment is also stirring slowly.
All right. So one last question before we let you go away. So we're done with GDP, and we're set for policy next week. So what are your expectations from the coming monetary policy?
Well, I think the monetary policy expectation is no action, which means that there is no surprise on the growth front. Actually, there's a positive news on the growth front. As far as I think the inflation is concerned, I think it has edged lower, and that's largely because of base effect, and also I think correction in commodity prices. So I think there is some comfort developing on the inflation front. So we would expect the pause to continue, and the guidance would still be withdrawal of accommodation, because I think the message that needs to be given is that we want to bring inflation down to 4% at some point in time, and we are working towards that. So we'll slowly, we were not raising interest rates, but we'll slowly withdraw accommodation. We'll continue to withdraw accommodation at this juncture, because it is still not at the level where we want it to be. I think so. From that perspective, I would see policy staying put, pause with withdrawal of accommodation.
All right. Thank you so much for taking time out for us today.
Thank you. Thank you for having me.
Stay tuned to BQ Prime for our continuing coverage.